In this week's video, we'll review the evidence we have in hand to help us answer the question, how concerned is the market about valuations, geopolitical events, predictions of gloom and doom, and/or an economic downturn? Given the stock market's performance year to date, let's say January 1st, 2017 to early to mid-December 2017, it's pretty fair to say that the market hasn't been overly concerned about any of the items in this week's title slide. How do we know that? The stock market has gone up. Therefore, as we walk through the charts this week, let's look at them in this context. What common missteps between January 1st, 2017 and the present day could have derailed us during a year where stocks have done well and the trends have been strong? This is a daily chart of the NASDAQ between June 1st, 2017 on the left side of your screen and August 31st, 2017 on the right side of your screen. We've removed volatile price to help us focus on trends. In this case, we're using relatively fast and sensitive moving averages. The 8-day exponential moving average, which moves faster than a simple moving average, the 10-day, and the 12-day. If we're falling prey to these common missteps, it's going to be very, very difficult to classify this type of look and this type of short-term volatility as volatility to ignore. If we're watching the market tick by tick, or checking our account balances every 13 seconds, we're going to get emotionally involved in these type of pullbacks, and it's going to be very, very difficult to ignore them. If the market starts to pull back here and we're worried about what everyone else is doing or what all of the talking heads are saying, it's going to be very, very easy to listen to all of the gloom and doom because we're watching things too closely. This is a bearish moving average crossover here. We have a bearish moving average crossover here and a bearish moving average crossover taking place here where blue drops below both green and red. If our primary objective is trying to avoid volatility, it's going to be very, very difficult to stay invested during a pullback like the one we're examining now. If we're always fearful of the next pullback or always fearful of the next bear market, every time the market starts to roll over, it's very, very easy for us to say the bears are right. The market is starting to align with the gloom and doom. And as clients and regular viewers know, under our approach, our job is to look at this and ask, is this volatility to ignore or volatility to respect? And within the context of watching the markets too closely or having a short-term focus, when we ask this question, we're indirectly asking, is this news event that's causing short-term volatility a news event to ignore or a news event to respect? Let's say we were concerned about valuations and the market starts to roll over. We would want to ask ourselves, is this data point something we should ignore at this point, or is this a data point that needs to be respected? And under our approach, if it's volatility to ignore, the weight of the evidence is telling us that this is a normal counter trend move within the context of an established and ongoing uptrend. Why is that important? If the big picture looks like an uptrend, by definition, eventually, if the uptrend remains intact, stocks will go on to print a higher high. They have to. That's the way bullish trends work. That's the way bull markets work. And under our approach, if it's volatility to respect, the weight of the evidence is telling us that this no longer looks like a trend that's going to go on and print a higher high, and now it looks like the longer-term trends are rolling over in a bearish manner. And it's extremely important that we answer that question about volatility to ignore and volatility to respect based on the weight of the evidence. Remember, the period we're looking at, this is June 1st, this is the end of August 2017. What happens if we look at the exact same period, but we take a step back and use moving averages that focus on a longer time frame, and thus we would be adding additional inputs to our weight of the evidence basket? Looking at this chart in isolation, it doesn't look particularly easy to navigate from a point A to a point B and stay fully invested. But if we take a step back and look at the exact same time frame, June 1st to the end of August 2017, now we're looking at the simple 100-day, 125-day, and 150-day moving average. If we're falling prey to these common missteps, we can visualize the mental anguish that can take place between this point A and this point B. We can visualize the emotional strain that would take place between this point A and this point B. Compare and contrast that with the emotional strain and mental anguish that would take place between this point A and this point B. Thus, by using just two sets of charts, we've shown the importance of considering the weight of the evidence. How do these moving averages look if we go back a full year? Now we're looking in the rear view mirror from December 7th, 2017. We're looking back 12 months. This is the 8, 10, and 12-day exponential moving averages. If we look at the exact same period from a longer-term perspective, it's much, much easier to understand how we could keep a level head between this point A and this point B. This type of movement and volatility in here is the market reacting to shorter-term and less meaningful news events and pieces of economic data. This chart helps us better understand the market's interpretation of the long-term fundamentals, the fundamentals that are driving the market from a longer-term perspective. Basic logic tells us that normal and 100% to be expected counter-trend moves within the context of an ongoing uptrend are driven by investors that have a shorter-term focus and are falling prey to these type of common missteps, or they're simply trading a shorter time frame. And if you're trading a shorter time frame, there's absolutely positively nothing wrong with that. Since the Nasdaq has a heavy weight to technology stocks, what about the other two major indices in the United States? Here's the S&P 500 using the same 8, 10, and 12 exponential moving averages. We're looking back 12 months here from December 7th, 2017. There's a lot of noise in this chart here, but these are normal counter-trend moves within the context of an ongoing uptrend. And we can even see that using these moving averages when we take a big step back. A bullish trend makes a series of higher highs and higher lows, which is exactly what we have here. But it's much, much easier to see the exact same trend and ignore the noise and the daily fluctuations if our model also looks at longer-term time frames or moving averages with a longer-term focus. This is the exact same period as this. The same concepts apply to the Dow. If we're looking at the 8, 10, and 12 exponentials, a lot of noise on this chart. If we focused in here, this looks very, very bearish. And this is a multiple week period here. This is a multiple week period here. It's much, much easier for us to understand what this is if we also know what the evidence looks like on this time frame. We've just shown that the simple 100, 125 and 150-day moving averages have been helpful year to date, helping us classify normal and 100% to be expected volatility as volatility to ignore within the context of an ongoing uptrend. Having said that, if we use these moving averages as part of our weight of the evidence equation going forward, can they be helpful when the market starts to peak? And conversely, can they be helpful at the end of a bear market when the market starts to flip from a bearish trend back to a longer-term bullish trend? Because if we don't know the answer to that question, it's going to be very, very difficult to be confident in our inputs. Now we're looking at the exact same 100, 125, and 150 simple daily moving averages for the NASDAQ. You can see as the market peaked here in late 2007, this looks a lot different than this here. So in this case, near a top, these moving averages as part of our weight of the evidence equation were helpful. How about when the market started to turn in 2009? Once again, we can see we move from a full-bore bearish look with blue, the fastest moving average on the bottom, and the slopes of all of the moving averages are down. And then we morph into a full-bore bullish look in mid-2009 with blue, the fastest moving average on top, and the slope of all of the moving averages are now positive. We can see this, measure it, and put it in a model before good things happen. We can see these changes, measure them incrementally, and put them in a model before really bad things happened in 2008. How do the exact same moving averages look today? Of course, we know the answer. It's much, much better. This really doesn't look anything like this transition period here from a long-term bullish trend to a long-term bearish trend. And this looks a lot more like this bullish and constructive period here in the second half of calendar year 2009. And it's extremely important to keep in mind, we're not making decisions based on any one set of inputs. And we're using these generic and for illustrative purposes only moving averages to help us illustrate basic concepts, meaning these aren't necessarily the permutations and combinations of moving averages used by the model. When we look at this chart, this is 2017 here, this is March, this is the present day here. We know with 100% certainty between this point A and this point B, we could have found countless bearish charts and indicators, scary historical analogies, and countless things to be concerned about. We could have come up with countless what-if scenarios between this point A and this point B. And this statement or this concept applies to all markets 100% of the time. You can always find things to be concerned about. Under our approach, we respect that. We want to make decisions based on the weight of the evidence, not a handful of scary charts or indicators that we can always find. How about the S&P 500? This is the look or morphing look that we want to avoid. This is the type of look that we want to embrace. And this is the exact same chart on December 7th, 2017. Similar situation with the Dow. This is the morphing look from bullish to bearish we want to avoid. This is a volatility to ignore look. This is a volatility to respect look in here in late 2007 and into early 2008. This is volatility to ignore within the context of an ongoing downtrend. This is volatility to respect, telling us we might be flipping from down to up. If we look at the exact same chart on December 7th, we can see it looks much more like this constructive period here than this concerning morphing look here. Once again, in the next segment, we'll be using simple and generic examples to illustrate basic concepts. We know from past videos that all market profiles on all time frames tend to fall into one of three major categories. Bullish uptrends, where the net aggregate opinion of all market participants leans bullish. Transitional periods, where the market tends to be indecisive. And downtrends, where the net aggregate opinion of all market participants about all topics, any topic we can think of, is bearish. And when the model is looking at multiple time frames and we have uptrends on short-term time frames, intermediate-term time frames, and long-term time frames, that's conviction. When we have a mixed bag on those time frames, it tends to be a transition or a period of consolidation. We can go sideways and then up, or sideways and then down. That's why it's so important not to forecast, but rather wait for the evidence to turn. If you're a client, I think it's important to understand how we will use these concepts and the hard data going forward. We all know in the present day, the weight of the evidence looks like the left side of our screen, and therefore that's why our allocations are heavily slanted towards growth and have been heavily slanted towards growth since the U.S. election, which is now over a year in the rearview mirror. When we have an allocation that's heavily biased towards the growth end of the spectrum, a fair question from a client might be, why don't we own any bonds, or why don't we own any precious metals in the form of gold or silver? The following hypothetical questions might help us put some context around the answer. Do you carry an umbrella when the forecast is for clear skies? Do you rush over to Home Depot and then board up your house when there's no threat of an imminent hurricane? If you were the captain of a ship, would you have your crew on full red alert when the waters are calm? Our present-day allocation and the allocation that we put in place in late 2016 was based on the facts that we had in hand and the weight of the evidence, which is very, very similar to the decision process we go through when we decide to leave the house without an umbrella when the forecast is for clear skies. And since we understand probabilities, we don't run out to Home Depot every day and board up our house. Typically, the weight of the evidence doesn't go from a look like this to a look like this in a day. Typically, we get some type of transition or indecisive period here. So in our case, if the data starts to deteriorate, we're not going to stay in this type of allocation. We're going to migrate to something that's more of a mixed allocation. And remember, earlier in the video, we said a transition period can either break in a bearish manner or it can break in a bullish manner. It can be a market consolidating its gains before it pushes higher, or a market that's about to roll over, which is why in this type of mixed environment, with mixed trends and mixed data, we would have a balanced portfolio with some defensive exposure, and we would maintain some growth exposure. Thus, in the present day, if things start to deteriorate, we'll go from a look like this to a look like this, and if they continue to deteriorate and we go into a multiple year or multiple month bear market, we can migrate all the way from a growth posture to a full defensive stance if needed. This could be bonds, cash, gold, silver, or any number of defensive assets. Just as our decision in this case is based on probabilities or the probability of bad things happening, the decisions that we've made over the past 12 to 18 months are also based on the probability of bad things happening, which is relatively low from a long-term perspective, which allows us once again to highlight a common misstep. When we're in a situation where the probability of bad things happening is low from a long-term perspective, That doesn't end when we get a small incremental change in the evidence in a bearish manner. Human nature says as soon as we see any deterioration, it's very, very easy to say the gloom and doomers are right, which is why that focus on the weight of the evidence and multiple time frames using multiple inputs is so important. Let's assume when we woke up every day, we ignored the weather forecast and we ignored the probabilities and we carried an umbrella around everywhere, even on the sunniest of days. That obviously would have some negative ramifications, and that's why we don't carry an umbrella with us everywhere we go all the time. Except when the probability is high that it's going to rain or that it's already raining. In the present day, there's also opportunity cost and negative ramifications for carrying that defensive umbrella around all the time. If we look back to about mid-June of this year, SPY, or the S&P 500 ETF, is up about 9%. Silver, over the exact same time frame, the umbrella is down 7%. And you can see TLT, long-term treasury bonds, IEF, intermediate-term treasuries, and defensive consumer staples are basically hovering right around break-even over the same period where stocks have tacked on 9%. There are negative ramifications for carrying that umbrella around, just as there can be negative ramifications for keeping defensive-oriented assets in our portfolio when the probabilities tell us that the threat of rain or the threat of a hurricane is relatively low. When we're over here, it doesn't mean we're assuming that skies will be sunny forever. We always have to respect risk and uncertainty, but as long as we look at the evidence that we have in hand with that flexible, unbiased, and open mind, and as long as we take the attitude, if somebody asked us what's going to happen tomorrow, the proper attitude is we have absolutely, positively no idea, but we're confident that we can wake up and that we'll be able to recognize when this type of data starts to morph into something like this, or when this type of data starts to morph into something like this. And thus, we're confident we can take the necessary incremental steps to get from here to here, and then to get from here to here if the observable evidence says that's a prudent thing to do. We don't move from here to here or here to here because of what we're fearful might happen, or because of some forecast or talking head talking about gloom and doom. And remember, from a defensive asset perspective, we just covered hard evidence that told us that both gold and defensive-oriented bonds may be entering a long period of underperformance relative to stocks. It's a probabilistic statement based on the facts that we had in hand as of November 22nd, 2017, and the facts that we have in hand in December of 2017. It's a higher probability that stocks will outperform gold in the months and years ahead relative to the probability that stocks will underperform gold in the months and years ahead. The underperform probability is never zero. Last time we had a setup similar to the setup that occurred in calendar year 2013, stocks outperformed gold for 16 years. If we link back to our original question, if the market in the present day, based on the evidence that we have in hand, was overly concerned about valuations, we wouldn't expect the chart of the Dow looking back 12 months and dated December 7th, 2017 to look anything like this. If the market in the present day was overly concerned about geopolitical events, we wouldn't expect The trends that we can see, measure, and put in a model as of December 7th, 2017, we wouldn't expect those trends to look anything like this. If the market, or the net aggregate opinion of all market participants, that same net aggregate opinion that determines the price of assets, was overly concerned about all the predictions of gloom and doom, or all the predictions of an imminent economic downturn, we would expect to see some deterioration or evidence of consolidation or increasing indecisiveness to appear on the chart of the S&P 500 as of December 7th. That's not what we have today. Is it possible that this chart could morph into something that's more concerning? Absolutely. Positively, yes. But we need to see it rather than just be fearful of it. And even if markets exceed expectations for many, many years to come, we know with 100% certainty there is going to be normal, 100% to be expected, and gut-wrenching volatility at times between a point A and a point B that could be several years down the road. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.